Bila-bila masa, di mana jua?
Hello, my name is Muhammad Fakuna bin Azmi.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Bushairi bin Azizi.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Aisyah Shamimi binti Muhammad Rasibi.
Hi, I am Siti Zulaikha.
Assalamualaikum warahmatullahi wabarakatuh. My name is Sharifah Arisa Sofia. So today we will present the industry and financial analysis of Apollo Food Holding Berhad. In this presentation, we will cover the financial analysis, analysis of liquidity and activities, analysis of solvency and capital structure, profitability analysis, and also the market strength and overall evaluation.
Today I will present for the financial analysis, which is qualitative analysis and quantitative analysis. So first we go to the qualitative analysis, which is what? So for the strength, the brand name of the company is its biggest strength. Apollo is a repute name in Malaysia and global market. It provides a unique strength to a company. The legacy and the experience of the company is another key strength of Apollo Food Holdings. The company has the experience in food industry in not only in the local Malaysian market but at international level. Apollo Food Holdings has several patents on its name. So next we go to the weaknesses. The employees of the company have limited say in the company's strategy making. They don't feel that their employees should have a say. So when it's come to executive decision, therefore management make all decision based on what is the best for the company rather than the employee themselves. So next we go to the trade. The biggest trade for Apollo Food Holding is the trade from competition. There are several players in the market that compete among themselves for customer share of mind and wallet. In recent time, the industry rival has also increased due to entry of various international players. In the current business environment, both domestic and international players compete together. So next we go to opportunities. The good things for Apollo Food Holding is that the FMCG industry is a growing industry in Malaysia and internationally. It is expected that the industry will have continued to grow at CAGR, compound annual growth rate of 7% to 8%. It means that the company will have various avenue target market to explore in domestic and international market. So next we go to the quantitative analysis, which is vertical analysis. As first, we go to the vertical analysis for the income statement for the year 2019, 2020 and 2021. From the overview of income statement, we can notice that companies' sales have decreased, but net income increased slightly. So distribution and administrative expenses have decreased slightly, which is logically given the increased net income. So the vertical analysis revealed the missing driver in Apollo Berhad's net income increase is other income, which from year 2019 to 2020 it has decreased by 2.61%, and from year 2020 to 2021 it has increased sharply by 9.96%. And administrative expenses decreased by 0.86% for the year 2019 to 2020 and slightly increased only by 0.81%, and it is not effective in helping to increase net income. Other income increased by 3.02% from the 2019 to 2020 and decreased to 0% from 2020 to 2021, and these expenses does big helping to increase the net income. Lastly, for the tax expenses also show some decrease by 1.6% from year 2019 to 2020 and slightly increased by 0.49% from year 2020 to 2021, and also a bit helping in increase the net income in 2021. As a conclusion, the company other income was 6.8% and 4.19% in year 2019 and 2020, but in year 2021 it spiked to 14.15%. That is the main drive that caused the increase in net income, even though sale is decreased. Next, we go to the vertical analysis for the statement financial position. For the non-current asset, it shows sudden drop from 58.81% to 57.08%, and show a slightly increase to 57.78%. So sudden drop from year 2019 to 2020 is because of there is changes decreased by 3.7% in investment subsidiaries, and following with the increase by 2.02% in other investment that acquired big percentage. For the current asset, sudden increase by 1.73% from 41.19% to 42.92%, and shows a slightly decrease to 42.22%. Sudden increase from year 2019 to 2020 is because there is a significant increase by 6.11% in trade and other receivable, and following with the decrease by 4.38% in cash and bank balance. For the slightly decrease from year 2020 to 2021, also because of there is slightly changes in trade and other receivable decrease by 2.59%. Okay, for the equity, we can see that slightly decreased by 0.01% from 99.7% to 99.69%, and show slightly increase to 99.78%. Slightly decreased from 2019 to 2020 is because there is same changes by 5.32% for the share capital and retained earnings. Lastly, for the current liabilities, it shows a slightly increase by 0.01% from 0.3% to 0.31%, and show a slightly decrease to 0.22% in 2021. It is slightly increased from 2019 to 2020 is because there is slightly increase by 0.01% in trade and other payables. For the slightly decrease from year 2020 and year 2021, also because of there is slightly changes in trade and other payables, decreased by 0.04%. Next, we go to the horizontal analysis for the income statement. It shows there is sudden drop for the net income from year 2020 to 2021 by 6.17%, even though in 2021 the income has increased about 161.8% from the year 2020, which is 92.38%, but still net income dropped for the year 2020 to 2021. For the administrative expenses from the year 2020 to 2021, it's only increased about 6.63% and not helping too much in drop a net income. Same goes for the other expenses. Even though it has decreased, but still the net income is still drop. For the tax expenses, there is increased difference by 28.58% from the year 2020 to 2021, and it is a big percentage. As a conclusion, the main cause for the drop of the net income from the year 2020 to 2021 is caused by the tax expenses that spikily increased by 28.58%. Next, we go to horizontal analysis for statement of financial position. As we can see, for the non-current asset, there is a slightly decrease by 0.4% from year 2020 to year 2021. The changes was main caused by decrease of other investment by 11.63% from the year 2020 to year 2021. So for the current asset, there is decrease of by 3.52% for the year 2020 and year 2021. So the main cause for this decrease is because there is changes in trade and other receivables for the year 2020 and 2021. The difference between the year is quite big of percentage, which is 19.93%. For the equity, there is different by 2.04% for the year 2020 and 2021. It shows decrease pattern from 107.05% to 105.46%. The main cause for this decrease is because of sudden drop of retained earning from year 2020 to year 2021 by 8.41%. Okay, last for the current liabilities, there is changes by 31.97% for the year 2020 and 2021. It shows decrease pattern from 108.18% to 76.21%. This is because of trade and other payables and current tax liabilities is decreased from the year 2020 to 2021. So I think that's all from me. We pass to the next presenter.
Okay, now let's proceed to the next slide, which is analysis of liquidity and activity ratio. Okay, the first element in a liquidity ratio is that current ratio. Okay, as you guys can see that in 2019, Apollo had a current ratio of 15.71 times, while it's further increased in 2020 at 16.65 times. Okay, it is due to the sufficient management of the company of current asset to meet out its ongoing current liability. Okay, in 2021, its current ratio had a slightly decreased at 15.87 times compared to the previous year. It shows that the company had a lower ability to pay its short-term obligation. Okay, let's proceed to the second element in the liquidity ratio, which is a quick ratio. As you guys can see that the quick ratio of Apollo in 2019 was 14.09 times, while in 2020, the quick ratio had been recorded at 15.05 times. Okay, it shows that the quick ratio in 2020 is higher than 2019. Okay, this indicates that the company can pay off its short-term obligation without relying on the inventory. In year 2021, the quick ratio was reduced to 13.89 times. It's due to the company does not have any sufficient liquid asset to pay off its current obligation. Okay, now I would like to proceed the next analysis ratio, which are activity ratio. This activity ratio is measure the Apollo ability to convert the asset, liability, a capital account into a sales or cash. Okay, the first element in an activity ratio is average receivable turnover ratio. Okay, the average receivable turnover ratio of Apollo in 2019 was 6.26 times, in which the company could convert the debtor into the cash. In 2020, its quote increased to 6.65 times, which due to the decrease in debtor as a credit sales. In 2021, the account receivable turnover was recorded higher at 7.16 times. This shows that a greater efficiency of the company in converting the debts into the sales. Let's proceed to the second element in the activity ratio, which is the average collection period. The average collection period in 2019 of company Apollo is that 58 days per year, whereas in 2020 its average collection period is 55 days. It shows that in 2020 there is improvement of the company policy because it managed to collect its debt 4 days shorter than previous year. In 2021, the average collection period has been recorded at 51 days. It shows that there is a decrease in credit sales by the company. The third element of activity ratio is inventory turnover ratio. Okay, in 2019, Apollo had replaced its average inventory of 9.31 times, while in 2020, Apollo had replaced its inventory at 8.44 times. It shows that the inventory turnover in 2019 is better compared to 2020. It indicates that the company has been successful in utilizing its resources. In 2021, the inventory turnover ratio had recorded increase at 9.53 times, which possible because of a proper handling of the inventory. Okay, the next element in activity ratio is the average age of inventory. Inventory holdings period for Apollo in 2019 is 39 days, while in 2020 the inventory holding period is 43 days. It shows that in 2019 is better compared to 2020. It indicates that the company's efficiency to manage the inventory. In 2021, the average age of inventory at the shortest compared to 2020 and 2019, only 38 days. Okay, let's proceed to the next element in activity ratio, which is account payable turnover. Okay guys, as you can see at the graph is the account payable turnover ratio in 2019 has been recorded at 16.33 times, and 2020 is recorded at 13.79 times, and in 2021 it's recorded at 14.08 times. Okay, as you guys can see that the account payable turnover ratio for Apollo for the year 2019 has been highest compared to 2019, compared to 2020 and 2021. It shows that the company could pay its debt quickly in 2019 rather than other years. Okay, the last elements in activity ratio is account payable turnover in days. Okay, the account payable turnover in days in 2019 was 22 days, in 2020 and 2021, the account payable turnover is remain constant, and it's recorded at 26 days. It shows that in 2019, the company is taking shorter to pay off its supplier. Okay, that's all from me. Thank you.
Moving on to our next agenda, which is the analysis of solvency and capital structure. So in this topic, we're going to talk about how Apollo Berhad managed its capital structure, and we also going to look at whether the creditor are protected in the case of solvency. So to have the answer for that two questions, we're going to go through three ratio, which is the debt equity ratio, debt ratio, and the last one, debt multiplier. See, first we're going to go through the debt equity ratio. As you can see the chart above me, there are slight increase in 2020 and the slight drop in 2021, showing that Apollo Berhad are using less debt to finance its operation. Having lower debt equity also means that lower risk of probability of bankruptcy in the event of economic shutdown, such as right now we are having pandemic. Next, having debt equity amounting to 0.002, putting Apollo in the favorable place, as the industry ratio are 26.69, showing that the creditor are more protected in Apollo Berhad if there were case of insolvency. We're moving on to the next ratio, which is the debt ratio. As you can see in the chart above me, you can see the slight increase and the drop down on this ratio throughout the year of 2019 to 2021. The drop in 2021 implies that Apollo are having more stable business with lower overall debt to operate its business. It also shows the sustainability of Apollo Berhad in the market. Moving on to our last ratio for today, which is equity multiplier. So, in the chart above me also, we can see equity multiplier also follow the trend, same as the other solvency ratio, with being slightly increased in 2020 and drop in the 2021. The already low ratio on the equity multiplier has decreased in 0.0009 in 2021, shows that only 10% of its assets are financed by debt and 90% of it are financed by investors through the equity provided, proving that Apollo are the one of the conservative investment for potential investors.
So I will present it on chapter 7, which is profitable analysis. So we started first on net profit margin. Okay, what is net profit margin? It's indirectly measure how well a company manage its expenses relative to its net sales. So regarding the graph that I prepared, in the NPM in 2019, the NPM rate is 37.37%, higher than year 2020 of 31.03. So here we can conclude that the higher the net profit margin, the higher the company gain the money. The company that generate greater profits of sales are more efficient. So the rate started to fall in year 2020 and has a lower rate net profit margin of 31.03% compared to year 2019. That make a difference of 6.34%. Apollo Holding Berhad record the highest rate of net profit margin in the year of 2021, which is the best time to invest in this current year, because higher net profit margin leads to higher profit. So in 2021, the creditors and investors evaluate that the company effectively can convert sales into the net income, because it record the highest net profit margin. And how a company can increase their net profit margin by first reduce their utilities or expenses, reduce the expenses by mean they can find cheaper sources for their raw materials. Another one is reduce their labor cost. Next is return on investment. It measures the firm's ability to reward those who provide long-term funds and to attract providers of future funds, or in other terms, it measures how much investors get back of $1 of investment in the company. So referring to the graph I have prepared, on 2019, return on investment of Apollo Food Holdings Berhad has a higher rate of 6.79% compared to year 2020, as it falls to 5.60%. So a higher return on investment percentage indicates that the investment against of a project are favorable to their cost. Meanwhile, Apollo Food Holding Berhad gained highest return in the year 2021 among others, and it increases by 7.03%, and the most investor would prefer a rate of return of 10% or more than that as a good return of investment for a long-term investment in the stock market. A better rate of investment will depend on factors like the risk tolerance of the investor and the time required for the investment to generate a return. So all else being equal, investors who are more risk averse will likely to accept lower return on investment in exchange for taking less risk. Likewise, investment that take longer to pay off will generally require a higher return on investment in order to be attractive to the investors. Return on equity actually measures how efficiently firm use the shareholders' money to generate profits for the company. So based on the graph provided, in the year 2019, Apollo Food Holdings Berhad recorded 7.11% of return on equity. The higher the rate of equity, the better the investment. The return on equity had reduced by 5.85% in the year of 2020 from 7.11% last year, and it make a slightly difference of 1.26%. And the highest rate of return on equity among others is in the year of 2021, which is amounted 7.33%. And this is mean that the shareholders' money are efficiently allocated to generate profit in this year compared to the previous year. Why the ROE is very important? Because this is the measurement for potential investor, because they want to know how efficiently a company will use their money to generate net income. Last one is DuPont analysis. Table 4 shows return on assets for Apollo Holding Berhad from the year 2019 until 2021. Return on asset is a financial ratio that shows how much a company profit relative to its total asset. The higher the ROA, the more efficient is that company in using the resources to generate profit. So as we can see, in 2019, every ringgit Apollo invests in its asset, it generates profit of 6.55%, and currently a drop in year 2020. So in 2020, the lowest ROA among the 3 years could indicate that Apollo have purchased a new asset, as it falls to 5.40%. If the ROA still remain low after the first few years, it indicates an unwise investment on the part of management, or else the lack of training program. Return on asset recorded the highest ratio among the 3 years by 6.65%, and it may cause of the qualitative factors such as effective advertising and marketing. So on that year, the sales increased by 1.15%.
So next, let's move on to the market strength and overall evaluation. In this section, we cover the earning per share, price earning ratio, dividend per share, dividend payout ratio, and also dividend yield. This graph has shown the combination of EPS graph, DPS graph, and also the DPR graph. The black bar graph will represent the EPS, the green bar graph will represent the DPS, and the line graph will represent the DPR. First of all, let's look at the earning per share, which is the EPS graph. As we can see in the graph, the EPS in 2019, it is by far have more profitable compared to the EPS in 2020. In 2020, Apollo EPS have dropped from 22 cents to 17.51 cents, which make the difference of 4.49 cents. And if we compare between the 2020 and the 2021, the EPS in 2020 is much low profitable compared to the EPS in 2021. In 2021, Apollo have increased their EPS by 4.16 cents, which means that the ability of the company to produce net profit for common shareholder also increasing. For dividend per share, Apollo have paid a steady dividend of 20 cents for the year 2019 and 2020. For the next year, which is the 2021, Apollo have raised its dividend to 25 cents per share. This shows that the company have financially stable and performing well in its current market condition, and an increase in dividend per share also signal that the management team is confident in the company's future profit. Next, let's focus on the line graph, which is the dividend payout ratio. In 2019, Apollo dividend payout ratio is amounted of 19.91%. It is a low payout ratio compared to the year 2020 and the year 2021, but it may be a signal that the company is reinvesting the bulk of its earning into expanding their operation. The dividend payout ratio for the year 2020 and the year 2021 are over 100%, which means that the Apollo is paying out more in dividend than earning coming in, which is not really good for the company financial health, due it might be cause for concern regarding the company's sustainability. Next is the price earning ratio. As we can see in the graph, it is a better purchase for the year in 2019 due to the lower ratio, which is at 17.81 compared to the year in 2020, which is at 17.97. The PE ratio for the year 2020 could mean that the Apollo stocks is overvalued. In the year 2021, Apollo PE ratio is much lower compared to the year in 2019 and the year in 2020, which is at 17.44. But it is a good purchase at that time because of the lower share price, which is at 3 ringgit and 76 cents per share. Lastly, let's look at dividend yield. As we can see in the line graph, the dividend yield for Apollo is clearly shows that a steady raising of its percentage from 2019 to 2021. The raising of the dividend yield generally tells that the company is doing well since it can afford to pay out more of its profit to the shareholders. Since Apollo is older and more mature company in settled industry, they tend to pay regular dividend and offer better dividend yield compared to the company that are much more younger and growing at the growing stage. For the conclusion, we can say that the company performance for the year 2021 is much better compared to the year 2019 and 2020. Apollo Food Holding Berhad are able to overcome the economic problem during the COVID-19 crisis in the year 2020 and have given a great performance to keep up with the economic challenge. This can be seen in their revenue, dividend paid, and also in their EPS, which all of this is financial instrument have shown an increase compared to the previous year. As we know that a higher EPS indicates a greater value because investor will pay more for the company shares if they think the company has a higher profit relative to its share price. Therefore, for the short-term future prospect in the year 2022, we can expect that the future value of Apollo stock will be higher than 2021. If investors are looking for the stock with a good return, Apollo can be a profitable investment option. Based on the stock analysis, we can say that it implies that there will be a positive trend in the future and Apollo share might be a good for investing for making money. Since this share has a positive outlook, we recommend it as a part of the investor portfolio. That's all from us. Thank you.